A very good afternoon. You're watching the newsroom right here on ET Now. The market is actually coming under pressure. It did not sustain the gap up opening. The Bank Nifty as well as the Nifty both actually came down. And what's happening is that even the small cap and mid cap end of the market, which are last 7-8 days outperforming the benchmarks today, in fact yesterday onwards cracked a lot. So advanced decline was hugely weak, and the breath which was standing stall for the last couple of days actually gave way. Look at what are the areas which are coming under pressure today. Large caps trading at day's low. Today we have a very special interaction planned with two guests today, one on the institutional side and one on the HNI retail side. Gurmeet Chadha of Complete Circle, and we will also be shortly joined by Gautam Duggar, institutional head of research at Motilal Oswal Institutional Equities, to talk about inflation and its impact on equities, on returns. Why is it important for investors and strategists to keep a track on inflation, and what could potentially do to your portfolio? Let's understand academically first what's the relationship between inflation, interest rates and returns with Gautam Duggar, and then we'll talk about how to protect your capital and returns and your portfolio as well. Gautam, good afternoon. Thank you so much for joining us. Gautam, yesterday the inflation reading in US came at a 40-year peak, but still the market actually jubilated briefly after falling. Last evening, India inflation also came almost at a 2-year high. And lately, the conversations among strategists do indicate that we are in an inflationary environment, and hence equities could remain under pressure. If you could explain to us, for the investment management followers, investors, everybody academically, why does this actually be a big worry for equities?
Hi, good morning, good afternoon. Hello.
Yeah, go ahead, Gautam.
Yeah, okay. So look, inflation is a reality. Years of easy money, easy monetary policies, and which got exacerbated post the pandemic, when central bankers over the world and governments also in the developed markets flooded the markets with a lot of cheap money to provide fiscal stimulus and also to revive, the economies. Now we are seeing the after effects of that, where inflation is trending upwards, and of course it also got a bit unnerved by the geopolitical situation which has been unfolding since February. So you have crude above 100 after a long time, and briefly you saw $140 print also on crude, which was highest after 13-14 years. And then, of course, some of the industrial commodities has also been rallying, which is creating its own sort of problems. As far as the equity market is concerned, not every inflation print is a bad news. If you go back in the earlier cycle, 2003 to 8, when our markets delivered fantastic returns, I think 25% CAGR from 2003 to sort of 2008, then you would have seen inflation was also trending up. So the linkage with equity market is not so simplistic actually, because sometimes it also conveys that growth is picking up, and which creates its own sort of inflationary, linkages. Secondly, there are sectors which also benefit from inflation, right? Not all sectors suffer from inflation. So commodity producers are actually a clear beneficiaries of that rising inflationary trends. Of course, you will have some segments of the economy which will suffer and will have second and third order impacts as well, as far as corporate earnings are concerned. But when you are trying to look at equity markets and trying to juxtapose this with inflation, it's very easy to get bogged down looking at 6%, 7%. I mean, Ajay, look at India. 7% inflation is creating so much of noise. If you look at 7-8 years back, we are used to having 8-10% inflation at CPI, WPI print. So it's not as if that we are seeing it for the first time. Why the noise is so stronger today is because your developed markets, which have been seeing 2-3% inflation, have suddenly started seeing 7-8% inflation. Very rarely have we seen India inflation being lower than US inflation. So that's why you're seeing a lot of discussion happening around it. if you for a moment keep aside the global economy and just look at Indian inflation comparison from the period of 2003 to 2000, or rather 2005 to 2012 and now. So 6% is the mandate for MPC, between 2 to 6%. The moment it crosses 6%, I think there are some implications that they have to be answerable to. But I don't think 6 or 7% is going to make life so difficult as far as equity markets are concerned. The job of the capital allocator will ultimately boil down to finding bottom of ideas and sectors which either are resistant to inflation and B, are actually beneficiaries of inflation. So some sectors will obviously you will have to relook at, given that if those sectors have a lower pricing power, you may want to rethink whether you want to have allocation to that. Sectors where there is a huge competitive intensity and there is a pricing competition, obviously we'll take it on the chin as far as margins are concerned. We are seeing that happening in the last 2 quarters itself. But I'm not in the camp which says, because inflation is 7%, suddenly all bets are off the book and you have to move out of equities. So sometimes, inflation, as long as it doesn't get into a hyperinflationary spiral, tends to benefit the nominal GDP, nominal corporate earnings, and for companies which have good demonstrated track record of pricing power, which actually serves as a lever to raise longer term margins over a period of time. So something like manufacturers of goods which are essential day-to-day items, while in the short term for a quarter or two they might show margin compression, which we are already seeing. But once consumers get used to those prices, then over a period of time volumes do make a comeback, and we have seen it happen cycle after cycle in the last 30 years.
It's a very good point which you made, Gautam, that we cannot be choosy on inflation. If we want our earnings growth of our portfolio companies, we want inflation, we want wage inflation for ourselves, but we cannot not ask for inflation on items which we are consumption oriented and we are consumers. So inflation actually, there's a positive side to it also, and that also means growth. Let's talk about a little more about the type of companies which are resistant, sectors which are resistant to inflation actually are beneficiary. For example, financials, if rates go up, some of the high quality CASA franchisee ones, if you could share some sectors which come, just handy on your mind, top of your mind, which are quite resistant, are strong, and perhaps even beneficiary of inflation.
So I concur with you. High quality banks which have higher CASA percentage on their balance sheet, they will obviously reprice their assets faster, and their deposits will obviously, the cost of deposit will not rise so fast. So naturally they tend to be a beneficiary. Secondly, they will also benefit with perhaps some lag if, working capital requirements of corporates go up. It will provide some sort of an upward, push to their loan growth and therefore NIMs. Some companies, even in financials where the CASA franchise is not solid, they may face pressure on margins. The second obvious beneficiaries are the B2C sectors where the market share is absolutely dominant and they have demonstrated track record of utilizing the pricing power which exists on paper. Right? So for example, companies like Hindustan Lever, Asian Paint, Pidilite, they've been, they've seen multiple cycles of commodity cost inflation. And we have seen how they've managed their margins over a period of time, say last 10, 15, 20 years. Obviously, in the short term, they will see some impact on their quarterly P&L in terms of percentage margins. But as things stabilize and, demand comes back, those prices do not fall much. Once you've taken price increases, unless you are seeing a price war happening in those categories, you don't see prices go back even when raw material prices start stabilizing. So with a lag of some quarter here or there, they tend to benefit, provided you have pricing power, dominant market share, right? Then some of the commodity producers, so for example, oil and gas, metals, they are obvious beneficiaries of this inflation moving up. And then you have sectors like utilities, telecom to an extent, which do not sort of have a very direct negative impact on their margins or profitability just because of general rise in inflation in the economy. What gets hurt, obviously, as we are all familiar, sectors like auto, where the margins are low and ability to pass on the price increases is very diminished, and especially demand has been suppressed for 4-5 years now. So corporates there will be very reluctant and think multiple times before passing on prices. So their margins will remain squeezed for a longer duration of time. Cement, which is essentially a commodity where your pet coke, coal prices have been going up through the roof. There you will see impact happening this quarter, next quarter, maybe even more depending on where the prices were to stabilize, because their ability to pass on prices to the consumer is very, very limited. And you've seen how competitive that sector is. Consumer durables, again, sector which has been sort of flattish for last 2-3 years in terms of their volumes. They may think again before taking prices, because after 2 years of absolutely battered summer because of COVID first and second wave, this year you are looking at a summer which is looking a bit more normal, and possibly they might want to ensure that their volumes do not suffer, market shares do not suffer. So they may think twice before taking price increases. So you might see continued impact on margins, and given the elevated valuations which they trade at, you would see impact on their multiples also. One general thing we need to be absolutely aware and cognizant of is when your bond yields are now where they are, 7.2, 7.3, maybe they will hit 7.5, we don't know. Clearly it puts a cap on equity valuations, and therefore you have to be absolutely sure at what multiple you are buying those stocks in such environment, and also be sure of their earnings visibility and pricing power.
Right. Just one last word, let's scratch that point a little more. In this kind of an inflationary or rising interest rate, however temporary or phased it might be, what happens to high valuation companies where market actually prices them to perfection, or some of the even small and mid cap? How should investors approach that? Is there a case for valuation compression in these kind of times on 80, 90, 100 times price to earning kind of companies? So what are your thoughts there?
Actually, it depends on your underlying earnings and cash flow characteristics. If your earnings are not getting impacted too much and your cash flow characteristics are not diminishing, then possibly you would see time correction happening there instead of a very sharp or a severe price correction. But if your enterprise is built on stories and narratives without earnings and cash flows, then obviously when money supply tightens, which we are seeing now, quantitative tightening may start somewhere around May or June, and rates are going up. Only the quantum of rate hikes is debatable, right? So those kind of companies, that trade has been there since October, November, where we have seen a lot of the high flyers without support of underlying earnings or cash flows have compressed, both in terms of their absolute market caps as well as the underlying equity valuation multiples, right? So very few companies can escape the wrath of higher rates, and if your performance is not coming from underlying earnings growth. I mean, look at it, forget individual stocks, look at the market itself. For FY10 to FY20, the Nifty earnings growth was just 6.5% CAGR. And Nifty gave a returns of 8.6 or 8.7% CAGR. Broadly, you can say converge with the underlying earnings growth. Last 2 years, we have seen 15% earnings growth in FY21. And this year, we are going to close at 35% earnings growth, which is the highest since 2004. So 2 years, cumulative earnings are up roughly 52-53%. Look at the market. Market was 12,000 odd, somewhere about January, February 2020. We are somewhere closer to 17,500, 18,000, which is around 50% up. In between, we went down, we went up. But broadly, again, the underlying driver, which is earnings growth, has driven the market performance. So that is what is, will also trickle down to individual companies also. If there is a strength of cash flow and strength of earnings, then irrespective of headwinds and challenges, the companies will find a way to deliver those earnings and cash flow based on their inherent pricing power, and markets will recognize that. This is a period where markets will start separating companies where the edifice is built on just stories and narratives, and companies where the strength of the franchise is demonstrated by the compounding growth that we have seen in earnings and cash flows.
All right, Gautam, thanks so much for your time. Very interesting inputs and also indication on the kind of sectors which are relatively resilient and inflationary environment proof. Thanks very much for your time. Let's take a short break on that note. On the other side of the break, we'll get one more market specialist to talk on this subject and how you can carefully craft your portfolio in these inflationary and high interest rate environment.